All right, everybody, let's get it done. What's going on, everybody? Happy Friday, huh? You ready? You don't sound very excited. Yeah, I'm gonna probably be cleaning gutters this weekend. Yeah, but before that, I'm gonna get a motorcycle ride in. So, one pays for the other. That's interesting. Yeah, they do. That's an interesting combination, though. It's a short-term trade, right? Yeah. In fact, this kind of goes in to what I was going to talk about a little bit today because I didn't get any requests for topics. Is positioning? Yeah, so this is fitting in really nice. So while he's looking for the picture that he's going to send, when it comes to market positioning, a lot of times when we have a down day like we did, we start to hear people talk more about hedges. And it's one of those words that I see thrown around a lot with the wrong context behind it. Just like the other word that I see thrown around a lot, scalping. It's a simple word to say and you can throw it around all over the place, but when I see people use the word scalping and then I look at their trade, it's not a scalp. Most of the time what they just took a trade and they called it a scalp. And we can call it whatever we want, but at the end of the day, you know, If it's not a scalp, it's not a scalp. Well, with hedges, just because you took a VIX call or you bought a SPY put, that does not make it a hedge. That's just a trade that would make money to the downside. And so when I point that out, usually what people say is, well, then help me build a hedge. Okay, you can do that. The problem with hedging is, first of all, it's a little complicated. To explain the complications, we're going to need a few minutes. So we'll take that time and we'll dig into it. First, I want to look at this picture Marziti got. He just got it up there. So let me bring it over so people can see it in the stream. We want to open this link. There we go. Oh, nice. All right. So we got the Microsoft on a 1 year daily chart. And Microsoft has issues right now, right? It's got issues. So they've been a little weak, anyways, while the rest of the Mag 7 has been performing well. Um, Looks like is running a sequence counter, and we got RSI down below, Heiken Ashi candles. Sure. It is worth noting for anybody who's listening that a Heiken Ashi is not a candle. I know it looks like a candle and it has wicks like a candle, but it is not a candle. And the open, high, low, close are not true. That's why we know it's not a candle. So if you're unfamiliar with this product and you go to apply it to your chart, just be mindful that just because it looks like a candle, you cannot use price action analysis the way you normally would by reading a candle's open, high, low, close, because this thing is going to lie to you. If we bring up, let's bring up something that has a little bit of better chart than the XLF. So here's the QQQ. And on the chart on the right, we have just a regular trend candle. And the chart on the left is the HA candle. It does look like the high and the low is the same, but the open and the close are off. So, yeah, you don't want to use this as a price action tool. Read price by reading price. Always remember that Heiken Ashi is an indicator that just happens to resemble a candle. Otherwise, it can mislead you. Even the color of the candle is not the color that you would expect. other than, if you're running a trend candle or a regular candle, the colors can change too. So that's by itself not too bad. So I like that. It's interesting, an interesting combination, especially when the Bollingers or Keltners or VWAP bands or any other channel band that you care to add offers standard deviation boundaries. So it's nice. It's a really nice little combination to put together. The really cool thing that I like about this is how well you could use it for scanning. If you built a scanner based on this, the the products that it would bring to you would be fantastic. I don't I don't like using indicators for trading, so that's never tickled my interest, but I see something like this and I think, man, you could narrow a pool of 5,000 stocks down into 3 or 4 names with a very simple scan parameter like this that most platforms would have, and you wouldn't even need to buy any special products or tools or scanners. Just probably almost any broker, if it's got indicators, would be able to scan for this. That's nice. One of the things about Bollingers too that can really help you out is their curvature. So you want to see, are they pinching together or are they spreading out? Are they in a narrow neck or are they in a wide boundary, a wide band? That'll really help you out. Um, if they're beginning to pinch together, it's a visual of volatility. I know a lot of people don't associate Bollinger Bands with volatility, but this is a visual representation of what volatility is doing. So if those bands are pointing together like they want to pinch, then it's showing you that volatility is constricting. Give me just a second, guys. I gotta send this email out. Price Headley came out with a band called the acceleration bands a long time ago that does a better job of representing that two standard deviation, where he wanted to capture a truer example of extremes. So um, he came up with that. It looks a bit more like a Keltner and less like a Bollinger, but it's called acceleration bands. They When I first started coding indicators, I ran across somebody who asked me about these. And so I did some research, and that's how I found out, that they were from Price Heatley. He did a couple of interviews back in the 90s and kind of promoted it. He was trying to get his name out there. So I did a bit of work on it. He said when he built this, he was looking for extremes that continued to run. And right now I've got it on IWM. And if we look at the early part of the year when we started to break down in February, it escaped outside of the acceleration bands and it stayed out of there into March. And then right before we had um, oh dividends, then price came back inside again. So it's how often price actually does that is really rare. But if you're looking for the powerhouse moves, like I remember Apple is really good about breaking the 5 bar rule. If you look at Apple from say December last year, it broke out of the bands and it stayed outside for like 2 weeks. If you're looking for those really strong ones and you're wanting to answer the question, is it still really strong? Then it's going to stay outside of the acceleration bands. It can still go up and not be, quote, really strong, but that's what he was looking for when he built it. So, it's there. I- It's um it's just something that I always think of when I look at something that's quote really strong is this, because when I was doing research and I was trying to find things that were really strong and or trying to see if they were slowing down, this is the first thing that always came to my mind. It's an easy visual. It doesn't take much on the learning curve to try to figure out. And of course, you can play with the boundaries or play with the bands, but yeah, I just tend to leave that stuff alone. So, um, the idea of a hedge, let's just get some background on this for a moment. If you have, say, your typical retirement account, you've been, putting money in it and getting matching funds from the company, and now you're in your late 20s, mid 20s, and you're just rounding over that $100,000 mark. And you decide you're going to run this portfolio for yourself, which you are allowed to do. So you take control of it, and now you've got $100,000, but it's not cash. It's already got a bunch of holdings in it. What do you do? Well, you've got to try to figure out when things get weak, how are you going to protect this $100,000? And it's all in, right? There's no available capital. That's all in the market, and it's all longs in various assets. Now, they would be more complicated. They would have bonds in it and all kinds of stuff like that. Let's just keep it simple and just say it's ETFs and stocks and, not even options at this point. It's just a bunch of shares. Well, how do we protect this? We would do it with a quote, with a hedge. The problem is you can't hedge the entire $100,000. You can't. The size of that hedge would be so big that it would become the source of its own risk also, right? Then there's the issue of, well, all the cash is in trades. I don't have any cash to add a hedge. Then there's the issue that, well, okay, if I was going to add funds and protect this, how much protection do I actually need? The market's not going to go to zero. How much downward movement is the market actually going to get? And then out of that, how much punishment am I going to feel in this account? AKA, how much of a hedge do I need? So, to be able to figure out your hedge, you need capital to deploy, and it's going to tell you how much of a hedge you can get. Because if you only got $20, you ain't got much of a hedge. But then you have to do analysis and look at the market and try to determine, well, how much threat is there? Do we think the S&P can fall back 5%, 8%? The typical quote pullback is 5 to 7%. A correction is 10 to 12, 15, depending on some analysts. And then a bear market is 20%. So those are three windows of opportunity that you could try to gauge with. Do I need a 5 to 7% pullback protection? Do I need 12? Let's just call it 10 to 15% pullback, or do I need greater than 20% pullback protection? Because that's now the question that we would need to solve. How much protection do I need? And once we determine which one of those three we want, well, how are we going to achieve that? What will grow my account or make me 5% of my account if we were to get a 5% pullback? And I've got an account that's got Apple, and Microsoft, and oil, and all kinds of stuff. How would I know how much damage a 5% move would even do to me? If SPY was to fall 5% or 7%, what would that do to my account? We need to be able to answer those questions to be able to get a hedge. And we would still need to figure out exactly what am I going to trade to make money when this goes down. VIX is the preferred product that everybody talks about, but do we actually see them use the VIX? Because a lot of times it's just MSNBC bozos chipping their teeth who don't actually have an account to show you. So you could use the VIX. You could also use SPY puts. Short calls wouldn't really get it done since that's a fixed value and it won't gain more money as it falls. It's only going to give you that fixed profit that it promised at the beginning of the trade. I didn't like any of this when I was trying to figure this out for myself. It's a rotating number of destruction, and you you get any of it wrong and you mess it up. And then trying to get a cheap hedge is only possible when you don't need the hedge, right? You can't expect to get really cheap fire insurance when there's a forest fire 20 minutes away from your house, right? You can get really cheap fire insurance in the middle of floods and that sort of stuff. But if you really need flood insurance, they're not going to sell it to you in the middle of a hurricane, right? So, same thing with your portfolio. Buying a hedge is crazy expensive if you wait until you actually need the hedge. So that means you got to carry a hedge constantly, all the time, buying it when you don't need it, and then just carrying that loss at all times because hedges are cost. That's all they are. They're not trades. So you're just setting money on fire and throwing it into the fireplace. And I don't know about you, but I don't like to do that. So that's a hedge, and I don't like it. So how could we do this, by the way? Well, you would measure SPY's pullback, and then you would try to calculate how much that could make you if you bought a put, and then try to calculate how many puts that would take and look at the cost of that. So if I was to expect SPY to fall 8% or 10%, we would try to figure out how much damage that would do to my $100,000 account and then buy puts to compensate for that at least 25 to 30% of the max loss. That sounds really disappointing, right? Covering 25% of the max loss. Plus, if we don't fall at all, I'm just taking losses all the time, just carrying these losses forward, and it just sucks. But that's a hedge. Most people don't even come close to doing any of this. They just say, "Oh, wait, we're going down. I'm gonna go get me a hedge." No, you're not. You're just getting a short trade. So, how do we solve this problem? Well, I like to do it constantly, just like the hedge, only balance it at all times. Every single time I go to put on a trade, I just ask that question: how am I sitting right now? Am I in an account that will make more money if we go up, or am I in an account that will make more money if we go down? The goal is to get your account to where it's shaped in like a risk reward profile that looks a bit like a rainbow, where the zero line is somewhere in here and price is right now sitting somewhere like this. And as long as SPY doesn't go too far that way or too far this way, then your account is going to continue to make money. We can go down 8 to 10%, we can go up 8 to 10%, and you're good either way. You're going to be making money. Every new trade you go to add, you look at this balance and you say, how's it looking? Because if you start to get the account skewed too far in one direction, then if we go down, you start to lose money, or if we go up, you start to lose money, and then you're offset, right? That zero line starts to become to where it looks a bit like this, and that's not what we want. Or it's going the other way and it looks a bit like that. Even worse, you can get into those situations where your account P&L has a risk profile that looks like this, where you need SPY to move 10% to see money higher or lower to get above that zero line. Those are bad situations, but you can look at your entire portfolio, gauge how you're doing, and when you go to add a new trade, just kind of ask that question: what do I need? Well, to do all of this, you want to sum your account up into something that is like apples to apples instead of apples to pineapples. Turn everything you've got into what we call SPY deltas. And that way you can gauge how your account will be impacted should SPY move up or down. Now you can use Q deltas, SPY deltas. If you're holding nothing but energy stocks, you could use, oil deltas. It doesn't matter. You just want to be able to compare your stock to something. Here on Thinkorswim, I can jump over to the monitor tab and we can look at this area here where it says beta weighing and how right now I'm not weighted at all. What you want to do is turn on the weighting and then choose the product that you want to weigh it against, like SPY, and then look at your holdings, and it will turn all of your holdings into SPY deltas so that you could then evaluate what to do next. And this is called beta weighing a portfolio. And if you maintain a beta weighted portfolio all the time, then you can adjust your position for each new trade you add just to stay in a sort of sweet delta neutral spot. Now, I don't do that with my trading account because with my trading account, I'm in and out. It doesn't matter. It's way too much work to do to a trade account. But in my longer term accounts, that's a really valuable approach. It's useful. And when you get used to doing it, it's just fast and easy. You don't even think about it. You're just like, I need some short deltas. Yeah, go buy a put or something. You know, there's always something going down. We could find a short somewhere. I need some long deltas. All right, go sell some puts or buy some calls. Get some deltas in the long side. Whatever it is that you need to do. That way when the time comes, if you get a surprise downturn in the market or whatever, you're not scrambling like crazy trying to figure out how you're going to protect the $100,000 that's now getting punished by the market. Beta weighing a portfolio. Now, some brokers are going to show you how to do that a lot easier than others. Thinkorswim does it, but it's a little wonky. Tasty does a much better job of it, really, much better. And I've got Fidelity. I was going to look yesterday to see because I don't use Fidelity when I do my beta weighing, but you can. What I generally do is I come over to Thinkorswim and I go to my paper side, which reminds me we need to go to paper to check that roll. But you go to paper and you build your position in from your Robinhood account or your Fidelity account or whatever. Build that position in Thinkorswim and then beta weigh your position using Thinkorswim. It's better than nothing. It gets the job done, and once you get used to it, then you're using a product consistently no matter what it is, right? That way, if you're like me and you have 20 different brokers, you're still beta weighing from one spot all the time. It makes it easy because you get used to doing it. But just getting a short on, that's nothing, right? We can always find shorts, we can always find longs. And hopefully you guys aren't getting too bowed up to the downside, right? We don't have those kind of signals yet. So if you're, I can't tell you how many times I've logged off to go to paper and log right back in on the live account. By the way, guys, Thinkorswim has a web version and you can jump from live to paper without logging out, but it's not a full sophisticated platform like the Thinkorswim platform. Still, you can go from live to paper and back again just by clicking the button and not having to log out. So that's really handy. When it comes to the beta weighing, I think I've already got enough positions on this paper account at the moment that we might be able to see what beta weighing would look like even right now. So let's see what we've got on here. Google, Intel, and Meta. I mean, it's not a lot of stuff, but it'll get the job done. So I'm going to uncheck beta weighing. And what we want to look at is the delta of this position. Combined, I'm running at an 85 delta. Well, that doesn't really tell us very much, right? Like what do I do with that? But if we turn all of those into SPY deltas or QQQ deltas, then we've got a better understanding of our risk. We can calculate what would happen if the market goes up or down, and we can figure out what we need for a new trade, either buying some calls or selling some calls, buying some puts or selling some puts. Here's my beta weighted position, and it's 22. Well, this 22 delta is representing 22 shares of the S&P market. That's my risk that I'm between these Google calls, these Intel calls, and these Meta puts. I'm holding the equivalent risk of 22 SPY shares long. That makes it very simple to understand what's my aggregate risk in this account. And if I wanted to gauge that risk, then of course we could come over and we could set this to SPY up at the top. Then we want to come down below and show portfolio beta weight. And this thing will act a little goofy if you have the simulated trades on. So we want to just hide those simulations. And I know it's paper, so it's all simulated. But what that means is if you're building trades and you throw them in the analyzer, they never go away. They just stay there in Thinkorswim, and it keeps them, and it continues to keep them until you clean them out. So it's going to try to read all of those, hide those, and everything that's left is the trades that you're in. So we've got Google, Intel, and Meta. And then of course, since we're beta weighing against SPY, it added SPY down here. Now we can see, what does the account look like? What kind of risk are we looking at here? We'll just kind of zoom in, and we can see that if SPY goes up, this account will make money. But if SPY goes down, I'm not going to be making any money here. If I was looking to add a new trade to this portfolio, then we would want to add something that would give us downside protection. In this situation, yes, we need to buy some puts, but that wouldn't always be true, right? Your account, maybe you've been shorting stuff for the last 4 months and yours looks completely backwards compared to mine. So, yeah, we need some downside trades. In this environment, that's not really that hard, but a week ago, it probably was a lot harder, right? When everything was still a lot more bullish than they are today. But we can go in and we can add some deltas, some negative deltas. To do that, when we're over here shopping around, we could add anything, but let's specifically add something. Oh, airlines got a little out of control this week, didn't they? That would be maybe something to look at. Yeah, we could get a few out of that. What else? I'm open to ideas. I don't care what we add. It can be short calls or long puts. Yeah, let's do some AI if it has decent options. Sure, that'll work. So we'll buy a couple of puts. And we didn't actually have to buy these. We'll let those go in. But you can just build some trades and throw it over there to look at it and see if you like it, right? You don't actually have to pull the trigger just to see what their impact would be. So if we look at Amazon, see if we can get a put. I don't really want to put a put on there, but well, I guess we could. Let's get something heavy, heavy, heavy. Nvidia. Yeah. All right. Well, we'll add a Nvidia put. Only with Nvidia, we're not actually going to add it. We're just going to analyze it. So right click on it, analyze trade, and that'll throw it over here. The problem with doing the NVIDIA like I just did is we hid all simulations. So I'm going to undo this for a minute, put it on single symbol, show all, hide positions. So now the only thing we have is NVIDIA. Let's undo that and get it to show us everything that we have. There we go. We got NVIDIA, the Qs, Google. Just look at everything. Because what we got to do is we got to clean out anything that doesn't belong in here, like all these that are not traded anymore. Those will give you errors. These are ours. Actually, we don't have any Qs on. So those must have just been things that we had built. Take those off. That's a trade. That's a trade. And oh, we got a diagonal in there. Take that off. Okay, so now it's cleaned out. The only thing that we have is that NVIDIA trade. So we can set this back to SPY. We can set this to portfolio beta weighted. And now that we've got that Google trade on, or the NVIDIA trade, let's turn it off. See how AI, when we added it, gave us just a little bit of curve, but it's way down here, and that's not helpful. We need to get this to either be that rainbow shape, or we need the whole curve to rise up. We need to get this central part to go up and this side to curve up so that it looks like a horseshoe, but it's above zero, one or the other. So if we add that NVIDIA position, now it's a lot sharper to the upside. Now we have a little bit of the negative delta now. If we look at a monitor tab, the monitor tab isn't going to show us NVIDIA, but it will show us that new AI trade that we put on. And as long as we're still running beta weight, we can see that the delta is now at 16. If we was to add the delta from here, then we would be a lot more negative, right? So let's go ahead and fill this trade. We might have to adjust the, well, I guess we did not have to adjust the price. That just filled instantly. Now we're at a negative delta. Okay, so our total aggregate negative delta is 7.76. We went from being positive to negative. So we're short 7 shares of SPY. Hey, Marziti, really appreciate you showing up. I like that Bollinger Heiken Ashi thing. Have you done any scans with it that gave you some chaseable results? Yeah. So you got to change the basket that it's looking at, huh? Well, I was thinking about the Bollinger Band percent might help you out too. Like how wide is the bands so that you can restrict it from those ones where price has already gone a long ways and it's stretched the bands out silly, silly wide. That way you can say, well, yeah. Yeah, because once it gets stretched out too stupid, then it's like, yeah, okay, that's worthless. It happens after stocks make a big move, like putting Bollingers on Palantir, for an example, would probably be a waste of time. Yes, sir. Have a good weekend. So, by running a balanced beta weighted portfolio, for every new trade you go to add, you can just ask that question: how's this trade going to help my aggregate position? And if you don't like the look, then you either just choose not to add it, or you find some other trade or some other way to take that trade that will give you different deltas, right? Maybe deeper in the money, deeper out of the money, a different expiration. And that way you can constantly monitor what your beta weight number is. To me, this is a comfortable way to do business, right? I never have to go and get excited about, oh gosh, it's looking negative out there. I've got a lot of long-term risk because I don't really have a lot of long-term risk. If we go down, I'm going to make money. If we go up, I'm going to make money. Mine doesn't look like this though. I don't prefer this shape. I'd rather have it the other way around. And you get that when you're more in sell to open positions. I do a lot of those sell to open positions. So, anyways, that's beta weighing. I thought it would be a good thing to bring up if you've never come across it yet before. It's certainly something to look into so that you can try approaching portfolio management in a new way. And I did not get a new trade on in the other account that I had mentioned. My concern on logging in is it's on the other computer, not this one. And if I log into that account from this computer, it's going to change my Thinkorswim settings to that account. And I'm going to lose all of my Thinkorswim settings on this account. And that's frustrating. So I have to back everything up and then do it so we can do the stream and I can log in on my other account from this computer and not lose all my settings. And I'm thinking it's doable. I just hadn't got it done. Because I still maintain that these rolls that we're doing in paper are not accurate. I don't think that that's really how Thinkorswim shows a roll when it's live. I think it's giving you this generic little default where it literally closes one and buys the other, and it doesn't apply any credit that you've earned or debit that you spent to the new position whatsoever. And that's just not how things work. But we're already over here. So if there's anything else you guys wanted to mess around with that would require getting in or out of the market, now's a good time to do it while I'm still on the paper account. Otherwise, let's take a peek at Fidelity's account. And I wanted to do a quick deep dive on the market, give you guys some insight on what it looks like out there from my perspective and how much risk we really have. So this is the MAG 7, just that ETF called MAGS. We used to run those homemade ones where you put Apple plus Amazon plus Microsoft plus Nvidia, blah blah blah. And I don't mind using those. And some of them are weighted with a bunch of different numbers behind it. But at the end of the day, after doing all that work and trying to figure out all those numbers, once you have it and then you compare it to the NY Fang or the MAGS ETF, it looks damn near exactly the same. And I'd rather have this one since it's I understand this. I don't know about you guys, but the one that has a bunch of numbers behind it, the weighting, I get to looking at that and then I think, well, how old are those weights? And do those weights need to be updated? And where did the weights come from? And then where do I update the new ones from? And what's that doing to the aggregate shape of the chart? Like there's just so many unknowns that I don't like it. I'd rather just use something like this where I go, oh yeah, that's an ETF. I know exactly what the heck that is. Right. And then I'm good. So I quit using those weighted ones. This is fine for me. The Mag 7 fell out of bed today, but we're not even down to the gap close. And I find that relevant, significant. So, yeah, we're a little weak today, a little weak, but we're not broken. Bring it out to the daily. We've got this gap up, what we would call an island up here. And we've been topped out for sure. It's a really nice topping pattern, but we haven't closed the gap. And so this is not broken. Put it on a weekly, we don't even have uh, a higher low here, right? We would need to fall down, set, say, a higher low, and then run up and set a lower high. We don't have any of that stuff. So this is not even in a downtrend. We're not even bearish yet. We got nothing here that says we should be short the market. This is growth versus value. It's kind of a really big deal in the grand scheme of things when you're trying to figure out who's in charge and capital rotations and all of that stuff. The swag line right now is 2.28 or 2.30, either one. And we're not below either one of those numbers. So until we get below 2.3 or the breakout of 2.28, there's not even any signal to go short. This pair is really good for the Mag 7. If you want to short the Mag 7, you need this going down. We don't have a lower low yet. We got a lower high, but not a lower low. No short here. And the other growth versus value, this one, this is better for the broader market instead of just the Mag 7 like the one on the left. This is for like everything else. And everything else, we're getting back into growth, not value. This is saying get into value or get out of growth, get into value. Tech stocks and consumer discretionary and everything that you would consider to be a risk on market. That's what this is telling you to get into. So this combined says there's no short here yet. Now this one, this is the liquidity tail, and that one is starting to pick up a little bit. There's some cracks in liquidity. Liquidity is boss, right? It's always boss. So when you see this going up, and this is the ICE Bank of America High Yield Index. It's options adjusted spread. That can get a little complicated, and you get into overnight repos and all that stuff. Don't stress on it. It just, if it's going up, that's bad, and if it's going down, that's good. And so you can see, for an example, back in April when Trump was first kicking in the tariffs and everybody was upset, this was pointed up, right? And it was really up. Then he capitulated, the market calmed down, and this thing went right back down, and it went down really fast. So down is good, up is bad. You could probably flip it over to make it more intuitive. That way, up is good and down is bad, because that's the way we generally look at stocks. But while this is kind of peeking its head up a little bit, and we've gone from 2.69 to 2.99, I'm just kind of rounding there, but that's close enough. That's quite a bit of movement, and it is a concern, but it's by itself. It's in isolation because we don't have any indication that it's affecting the broader market yet. So that's one tell that says you should lighten up, take a little bit of profit off the table, remove some risk if you can, because liquidity is starting to tighten up some. Okay, I mean, I take that. This is it's not your traditional flight to safety, but it is weighted versus unweighted. Think of this as who's performing better. Is the Mag 7 outperforming the broader market, or is the broader market outperforming the Mag 7? And generally speaking, the Mag 7 generally outperforms the broader market. When it doesn't, the S&P goes down. That's usually how it works. It's not how it has to work, right? That's just usually how it does work. So when the pink line, which is the S&P, when it's going down, when SPY is falling, the ratio usually goes up because the Mag 7 is underperforming the broader market. Well, we can see way down here that SPY had one heck of a move to the downside, but we barely even have a little blip to the upside here. So that's nothing, right? We had the same kind of move back here or right there, right? Right there and there and there. So that one itty bitty little blip is nothing. This is telling us we don't have any risk yet that the Mag 7 is significantly underperforming the market for an extended period of time. We got one day with one little wiggle to the upside. This is the same chart. It's just for the Qs instead of the S&P, but it's the same logic, right? The pink line is the QQQ instead of the SPY, and then we got the weighted versus the unweighted, and it's still all the way down here, and it does not look like a threat at all. Tiny little wiggle. That's it. So don't want to try getting short in that market. This is a really good indicator for quote tech, old tech, new tech, fintech, uh, hospital tech. It doesn't matter, right? Anything tech. This is just tech. So as long as this, and I always use it on a monthly, as long as this is headed to the upside, don't short tech. If this gets into a resistance area, a previous high, a place where we were rejected, when there's risk, this is a really good one to pay attention to. but we don't have anything to hit now that we're almost holding this breakout of last month's candle. The next level is up here. We got close to it, but we didn't hit it. So that's the next area of risk, but we're not there yet. In fact, since we pulled back, we've got room before we get back up there and hit it. But this is still green and it's still pointed to the upside. And that says don't short tech. This one's a concern. It's most definitely a concern. This is the Mag 7, excuse me, this is the Japan, US 30, Japan 30 combo ratio. It's a really good tell on how the broader market is doing. But when it comes to the markets, you always got to ask, hey, what's moving the market? News can do it. 0 day flows and the options can do it. Treasury. Yesterday it was dollar and bonds. So we never know, right? We got to go look. Hey, who's bullying the market? Who's in charge? This says it's FX markets and treasuries that are in charge right now. And when they got a hold of the market, then the 0 day flows don't have a chance. They'll hop on board and go with it. They won't go against it. At least I've never seen it. That would be a heck of a battle, though, to see those two, say 0 days trying to run it long and this is trying to go down. Bonds would win, right? There's way more money in bonds and treasury than there is in equities, but I think it'd be a fun battle. It'd be like samurai warriors showing up to a gunfight. The guns would win, but it'd be a heck of a battle. So we do got some warning signals here. It's broke down significantly, but it's not by itself. If you look at the orange and the cyan colored line there, they're all three performing exactly the same. So the indexes, the ratios might be a little different to how much they've fallen, but they're all in sync. So no outliers, and it's not out of control. So getting out of control, this one in the middle is the same as the one on the right. It just doesn't have the Qs and the S&P. Getting out of control would be breaking back down inside of this level here, and we're not there yet. So below 10 would be a concern. We're not even in the 10 range, let alone under the 10 yet. So it is something to keep your eye on. It's noteworthy that we've fallen like that, but we fell like that back here in July, and it was just a little speed bump before we finally got that breakout that we've been trying to get forever. So, for all we know, this is now the high, and that we're going to run up there next month and break it and go higher for all we know. Right? I don't know. Nice little pullback, though. It's worth keeping your eye on. This is a little bit of a tell for volatility. I had a really nice write up from AI that I kept. I must have accidentally deleted it. Usually I can just zoom out and see it. But I had talked with AI once about a better description for this. And man, she did a really good job of describing it. The main thing is compare it to where it was before. So when things are bad, say at the tariff wars back in April, right before Trump capitulated, you'll notice it looks a lot like the S&P. We were down in the S&P and in the Qs, and this ratio was down a lot. It was way below the extreme lows here, and then he capitulated and it turned around and it ran back up. The difference is we didn't get back to highs. We didn't break out and go higher here. We went just back inside the range because this is a ratio. It's not supposed to, break out and get into wild spaces. It's supposed to stay in a collar type range. So we're in the zone and we're at the common reversal point right there. That's a really key level. It's exactly like it sounds. Price falls down, SPY, the Qs, whatever. We reach that point where we expect them to monetize the options and flip everything around and run it back up again. So this says, yeah, we're about there. Look for the market to flip around and go back up. But look, this isn't a timing tool. So this isn't telling you to just go out there and buy calls today because you think it's all safe and good to go. It's just telling you that from here on out, if we're going to go lower from here, we're going to need some sustained negative pressure, more bad news, something that kicks off that continues for multiple days, something. Whatever we had so far doesn't look like it's going to be enough, right? So that's what this is telling us. We're at the common reversal point. If we continue to go, we're going to get into extreme costs, and that'll be an options extreme cost. That's when they really start to swell up in value and it gets way more expensive to buy hedges. And of course, that's where funds and firms start to blow up. So we don't want to see it get into that zone. Usually they blow up though if we get in there really fast. If we ease our way down, they have plenty of time to work their way out of it. Um, I don't know how comfortable you guys are with the concept of backwardation and contango. They're really big, fancy words, and they usually scare people, but it's not scary. It's just fancy language. So when you think about time, say 3 months and one day, if you're trying to quote me a bid for a project and you want it done tomorrow, well, that would be pretty easy, right? Because you could just look at what the cost of lumber is, or the cost of fuel, and the difference between today's cost of fuel and tomorrow's cost of fuel probably not going to be that big of a difference. But if you're quoting me a project 3 months out, well, that's going to be more tricky because in 3 months we don't know what could happen to fuel prices. Hurricanes will be in winter time. There's all sorts of things that could go wrong and make the price of fuel a lot more expensive. So anything out in the future is more expensive. Look at options. Theta is time, and so you go farther out in time, you got more theta packed into it. Options are more expensive. This behavior, where things are more expensive in the future, that's called contango. It's just normal, right? It's just normal. So with this kind of curve, that's what you want to see. Volatility is higher farther out. Options are more expensive further out. Costs are higher further out. If that happens to change and the front end of the VIX is more expensive than the back end of the VIX, this is what we call backwardation. It flipped over. What used to be cheap suddenly got expensive, and what used to be expensive suddenly got cheap. We don't want to see backwardation. There's a lot of ways to visualize backwardation. The most simplistic way is just to bring up the VIX, but really anything will do, right? So here's the SPX. We can bring up the SPX and we can ask, hey, what's the VIX trading at? SPX 30 days out. The VIX is trading at 2063. Is that right? 2112. There's a little discrepancy there. The 30-day SPX implied volatility average is the VIX price. You can get a day or two off, right? We didn't have a 30-day. I was using a 31, but it's close enough. This concept of volatility helps us try to define what's the volatility like. You can look at the options on the implied volatility level here. You can look at VIX futures. What did that do? There we go. These have dates on them. So the October futures are trading for $20. The November ones are trading for 13. Oh, those are in betweens. 2110. So we got 2055, 2110, 2120, 2185. It looks like things farther out are still more expensive. Well, that's good. That's exactly what we want to see. That the farther out we go on the curve, the more expensive stuff is. That means the shape is still there and it looks like this. If we were looking at these numbers and the front end was more expensive and the back end was less, then it would be looking like that. And then we're in backwardation. But what if you're on Robinhood or something, or you're in a hurry, you're on TradingView, you don't have options, you don't have these, and you want to see, hey, are we in backwardation? You got this. It's the VIX 3 month versus the VIX, which if you don't know the VIX by itself, the VIX, that's a 1 month. So we're looking at VIX 3 minus VIX 1. That's all we're doing. And in that ratio, if we're going up, then the VIX 3 is in control, it's outperforming. And if we're going down, then the VIX 1 month is in control and it's outperforming. Well, remember, if the VIX 1 month is outperforming something farther out on the curve, then you're in backwardation. We are in that right now slightly. So this is going down. If we get below 102 or 100, then we're completely in backwardation, which is like the April low here with the tariffs or last year here and here. So are we in backwardation? Nope, but we're moving in that direction. And that's a little bit of a concern. This is also warning you, don't get long in the Mag 7. When we break 1.18 and we're headed to the downside, do not get long in the Mag 7. You don't necessarily need to go short the Mag 7, but this is telling you don't open any new trades in the Mag 7 because we broke 1.18 and we're headed down. It could just fall like that and turn back up, or like that and turn back up. We don't know, but those warnings should remind you that you don't necessarily want to go short the Mag 7. Of course, it could fall like that, and that would be more extreme. Those were good shorts in the Mag 7. So by itself, this is not a trigger or a tool to tell you to get in or get out of new trades, but it is warning you this is not a good time to get short or get long in the Mag 7. Nice little warning at the bare minimum, right? So, when you're looking at Apple and you're like, I don't know, it looks really good. That apple looks nice. I think I like it. This is saying maybe you should wait a couple days. Probably don't want to try to get it right now. Now, this is just a little more complicated, but it's the VVIX again versus the VIX. So the VVIX is the implied volatility of VIX. That can get a little complicated. So um, here's SPY. And down below, we can put an implied volatility indicator on it. Why not, right? So that's the implied vol. And if we were looking at something that maybe has earnings, like Google, things that have earnings usually get an implied volatility ramp, and then they have earnings and they get volatility crushed or vol crushed, and then they ramp up to another earnings and they get crushed, and they ramp up and they get crushed. But it's implied volatility. And you probably are pretty used to that if you trade options. But what about the VIX? It's not like you can go put a volatility indicator on the VIX, right? That's weird. That doesn't work, by the way. It doesn't work at all. So, how are we supposed to know when the VIX has volatility? It's kind of a weird thing, right? What's the volatility of the volatility indicator? Huh? So, to do that, you look at the VVIX, which is the volatility of the volatility indicator. And when you look at that, it'll tell you, is the VIX getting more volatile? It's another way to gauge all these quiet periods when the VIX isn't really doing anything and it's just going sideways. And you look at that and you think, man, the VIX hasn't done nothing in 3 weeks. This thing's asleep. Is anybody even looking at this thing? It doesn't look like it's been doing anything, but the VVIX might have been giving a warning that volatility was actually picking up. Yeah, volatility's been rising since the 1st of October when we got into this new quarter. There, this new month. So a little bit of a hint on what volatility is doing and whether volatility is becoming more volatile. Well, we take that back to the indicator, to the chart. All I did is overlaid them on top of each other so that I can see, hey, what's the VIX doing? The VIX would be the blue line. what's the VVIX doing? That would be this pink line. And then what's the S&P doing? And that would be the green line up here. I need to turn that around so that the S&P is pink and the VVIX is green. But it doesn't matter, right? At the end of the day, it's all goody. Look back at April when things got out of control, the whole April tariff capitulation, blah, blah, blah. And it was pretty extreme. So just little warnings. The VVIX can start moving before the VIX itself does, right? So I like having that on there just to kind of see if we're getting any early tells. Then you just got the 10-2 curve. It looks exactly like it did yesterday, guys. Right? If I was looking at this trying to get a some kind of tell on the market, nope. Looks like yesterday. It looks like last week, like last month. It looks like May. Yeah, nothing, right? Nothing. Bonds, different structures, 2-year, 5-year, 10-year. We got nothing, right? Bonds are up, but we knew that yields are down. Bonds are up, and this chart is just nothing. Somebody was asking a question, and I was looking at it. This was my gold ratio, so hopefully this didn't get saved, and I can go in and find my gold ratio again. That sucks. Let's see. It did. It saved it. Dang it. Oh well. So those charts I thought would give you guys a little bit of insight on the broader market. We've only got two charts that gave any warning at all to downside, right? The rest were either nothing at all or just slight negative. And that's not good enough for me. I wouldn't want to go and pile into the market short. There are a few caveats to all of this, right? There's the market phrase that says if you wait for confirmation, you have to pay for it. And that's absolutely true. It costs you money to wait for confirmation. Trades are more expensive, stops are bigger. It's just confirmations are expensive. But you will lose less often if you wait for confirmation. The thing is, trading isn't about winning and losing more often. It's about making money, losing money, and making more than you lose, right? So waiting on confirmation is not necessarily the right thing to do. Everybody's just got their own approach to it. All right, in the red line here, we've got down volume. I'm supposed to have up volume on there too, but whatever. And then down below, it's the percent index. How many stocks are above, how many stocks are below a particular moving average. And I think this one is set to 200. Let's just go in and see. We're using the NASDAQ 50, and I believe it's set to 200. I guess that was stocks above the 50-day. Stocks above the 200-day moving average. We've got 58 stocks above the 200-day moving average. It's a market breadth signal, right? So if you look back at April, a lot of stocks were below their 200 period daily moving average, and the whole broader market was pretty negative. Now we're still above the 50% line, but we've been chopping sideways here for a while. If you've been thinking, gosh, it's so hard to find a trade right now, yeah, that's what this is telling you. A lot of stocks are above their 200, but they're not expanding. And the ones that are up there, we're not getting new ones. We're not losing any. We're just hanging out there with that same number for 2 months now. 2 months just hanging out there. If you zoom in, it actually looks like we're losing it a little bit, but man, it's a minor amount. Stocks above and stocks below a moving average, when you're looking at a total index of say 100 names, the Nasdaq 100, the S&P 100, if you find more than 50% of those stocks below their 50-day or 20-day, 200-day, then you can get a better perspective of their market breadth. Yeah, Nasdaq 100 stocks above the 5, the 10, the 20. We can set this indicator to different levels. And that's just referred to as market breadth. So it's not breaking down like it did in April. It's weak, it's lower than it was earlier in the year, but it's not crashing and burning. Even today, it's only down a little bit. Of course, if I remember correctly, the stocks above and stocks below indicator, the market breadth tool, it won't update until after the close today. So we would probably want to look back at this on Monday and then gauge to see if we ended up with one of these really big bar days. Because notice how there's no wicks. Well, that's a little tell that it's just updating at the end of the day where we opened and then where we closed, that sort of thing. So that's probably not going to be helpful today. I mean, I'm more than happy to share them. Um, I don't, I don't think I have a central database of TradingView. I probably need to because I'm using it a lot more now than I used to. But um, yeah, I don't really have a central database of them. No, I'm not allowed. Oh, yeah, yeah. In mine, yeah, because I'm not allowed to add channels here. But in my Thinkorswim Discord, yeah, I think we're going to be getting a new channel in there. We probably need it, right? Like I've got a lot of charts. Um, yeah, I figured you did. My mind got there. It's just a little slow. It feels like I've done this before, and what that means, very likely, is that I did build it, but it was in my private Thinkorswim Discord, not my public Thinkorswim Discord. But it doesn't matter. We'll get it done. I do have a TradingView channel. I went in there and went poking around. So there's a TradingView category and some indicators that I've either modified or found somewhere. Um, this just, I don't know, hotkeys and that sort of stuff. So we'll put it in there, right? We'll put it in macro and ratio. Better name these things or we'll all be looking at them going, what the heck is that? So I'll get into that probably over the weekend. And then when I get it done, I'll let you guys know and you'll be able to go and grab them. The main thing is understanding that there are so many tools out there, guys. Like there's so many. And I am constantly reminded that I don't know everything because every day I find a new ratio that I'm like, oh, wow, this is awesome. And somebody says, yeah, I've been using that for 5 years or 10 years or whatever. And I'm like, what? How did I not know about this? Every day I learn something new. So the the main thing is when you come across an idea, anything, if you want to look at gold, bonds, treasuries, platinum, palladium, it doesn't matter what it is. The first thing you want to think of is how can I normalize this or compare this to something that I do know, putting it into some form of a ratio. It's hard to find ratio matches. I've even gone to AI with this and I've asked like what's a good growth versus value ratio? And it'll give me 30 different answers. And I'm like, okay, but which one of those? Like you know what I mean? Like that's not helpful. Don't give me 30, give me one or maybe two. And then explain why I would want two. But so that's not I haven't had any luck with that. Yeah, this is recorded. They're always recorded. It will be in the stream replay. And I try to add a description afterwards. I try, guys. Sometimes, I don't do a very good job. And on the old videos where I wasn't doing it, my wife has graciously volunteered to go back and listen to all the old ones and write up a little summary of what I was talking about that day. So they will be added. They're not added yet, but it'll probably happen in the winter. You know what I mean? Like when it gets colder and we're not out running around on as much. That way, you can go back in the past and find streams, and it has a description of what we talked about that day. Because we talk about a lot of really good stuff, but how the heck would you know if it's just a stream link and there's no discussion about what we talked about that day? I mean, sometimes I do, but for today, for an example, I didn't have any topic recommendations. So I just decided we were going to talk about hedging and protecting the portfolio and taking a look around the broader market. I didn't have any notes for today, right? Because I didn't have a topic request. And there was a long while where I'd say 6 or 9 months that we was just posting the links and not giving any description at all because we didn't think ahead on the idea that hey, you know what? Somebody would probably watch the replay even 6 months later if they knew what the replay covered. So I'm getting them done, at least my videos. She's not going in and doing everybody's videos. I did have the idea of feeding the video link into AI and asking AI to summarize, but if there wasn't closed captions or a transcript, an SRT file with the video, then AI is giving me the answer of, sorry, I need an SRT or a transcript. Now, every week AI is getting better. So my hope is by January, somebody will have a new AI program out there that you can just copy the YouTube link, give it to AI, and it'll give you a 3 sentence paragraph of what broad outline of what was covered that day. And then we can just do every video that's in that channel and be good. Be awesome. So I'll try to get those links done by Monday. Worst case scenario is it'll be by next Wednesday, but we'll get him over there. All right. So I had mentioned on Wednesday the way we used to stream, where we would just bring up the Dow and just take trades and carry trades, basically everything that was in there. It sounds like a lot, but it really isn't all that bad. And I was talking to somebody about it today, and they're like, "Well, you're crazy because that's my hard-earned money, and I don't want to lose it." Well, I don't want to lose my money either. That's the idea is to make money, not to lose it. And we wasn't going in there putting those trades on just to get a trade on. I'm not a fan of taking a trade just to take a trade. The point though is that you can trade anything with options, right? You could trade up, down, sideways, whatever you want, because that's how good options are. So with that in mind, if you was to look at something like the Dow Jones, put them in alphabetical order and bring up any one of the charts, there's always a trade there. The question is, what's the risk? If we're too close to earnings or we're too close to the new dividend, then, that's risk, and it's a greater risk than we would have had if there wasn't earnings. So that's got to be taken into account. But we can jump over earnings, right? Take Apple for an example. Earnings is October 30th. Okay, that's kind of close, right? It's the end of the month. But we could use November options expiry, and now we've jumped that earnings. It's not a big deal, right? It's 1 month out from the upcoming options expiry. Yeah, that's nothing. So then we have to try to determine, all right, well, what kind of trade we want to take. I like a higher probability trade where the market doesn't know that it's a higher probability trade. So I want to lean against something. Well, today I couldn't lean against anything. We just had a big expansion to the downside and we got a gap closed. If I was looking for anything, I guess it would be that gap close. So, jump in there, look at Apple, November options expiry. Got a 21 point move. So if we went at the money and made it just the cheapest, smallest thing that we could make, $5 wide, $2 in credit, that's not bad. And I'm out of the money in one strike. I didn't straddle it like I normally would, but that's not bad right there. We're risking three to make two. Remember, you don't get a really good risk to reward in credit spreads. If we did want a real half and half, then put one in the money, one out of the money, and that trade right there has nearly a 50% probability of success. And yet I've got a higher probability than that because I'm leaning against this gap close. Now, I don't know how to apply probabilities to things like QRA, FOMC, earnings coming up. All of those things will definitely be an issue. They are. They're just going to increase risk. But that's a tradable opportunity right there. It's valid. It's a good trade. And it's not the idea of, well, I want to put on all these trades that won't lose. Yeah, good luck with that. You can spend all the time in the world trying to figure out a way to not lose. But at the end of the day, it can still lose. You're just fighting the inevitable. So put the trade on with a plan on how to limit that risk or manage it if risk comes and move on. Just get the trade. So what? So with that in mind, you can just go down the list. AMGN, what do we got? Right? It's the midpoint of this big bar. So we would put the trade on either using the midpoint of that big bar, or since it's broke and we're now underneath it, then we'd run the short. So running a short in this, it's kind of expensive. I don't think the options are that good either. Yeah, they're not bad. Yeah, okay, maybe they are bad. 70-cent wide bid ask spread. Yeah, that's pretty bad. But it has weeklies. Let's see. Can't even get anything cheap. Um, Try an unbalanced fly. Get some credit, apply that to the market. That'll do it. See how we got some upside here in case it does try to go up? That's the idea that from our current location, we expect to go lower, but we could bounce some first and then go lower. And this gives us that window. Still looking at options for November. And because it is a spread, if we need to, we can adjust it with a roll. We basically need to stay under $300. That's not perfect, but it's close enough. Well, $300 is all the way up here at the top of the range. So we're putting on a trade that says, yeah, I bet that range holds and we don't close above it and go higher than that by the middle of November. I'm pretty good with comfortable with that trade, right? What are we risking in this, by the way? If we run higher than $300 and we never close the trade, which why would you not? But whatever. Say we go on vacation, we forget the trade is even on, max loss $313. You would have to sit there in that trade all the way to expiration to get max loss. You know what I mean? Like it won't happen on accident. You'll earn that max loss. More likely, worst case scenario, you lose two-thirds. And that means you would lose $200 out of a $300 trade. I don't want to lose $200, by the way, but right? You could risk, say, 100 or 150 because it has bare minimum profit of 187. Well, that's basically 190. Why not risk 190 to make 190? Call that a 50-50 trade. Put that on. I like that one. You see what I mean? Like go down the whole list because that's what we used to do. Just bring up the next stock, evaluate it, put it on, go to the next one, evaluate it, put it on, go to the next one. As long as you know what you're supposed to do with the trade, if it begins to not work out and you've already got a plan and you stick to that plan, it doesn't matter if you've got two trades on or 2,000 trades on. Now, what we're doing here is not using that beta weight at all, but you could, right? You could consider every new name that you get to and then ask that question. Well, what do I need? Do I need some deltas? Positive? Do I need some negative deltas? And then just continue to keep that portfolio balanced with every new trade that you're putting on. Amazon, higher IV. We're at the low of the range. Mid November, low of the range. That would be a spread, probably a short put vertical or something like that. 245 in credit. It's not bad. It's a 50-50 trade. If you want a little edge to it, you could set it just out of the money and collect $2 while risking three. But I like the at the money. We are not closed money. Bonds are closed Monday, but not equities. No, it's like that every year too, and it's confusing. It always confuses people, and I don't blame them at all for being confused because it's one of the few times where it's split and that we don't have um, everything open or everything closed. So yeah, bonds will be closed Monday, which is going to make for a screwy day in the equity markets, anyways. It always does. All right, now we got American Express close to earnings. Continue to move to the downside. It's not just today either. This thing has been steadily marching to the downside. It certainly doesn't look like the trend is done. Short term bounce likely over the next few days, but the bounce probably doesn't stick and this continues to go lower. I'm comfortable with that 325, but let's run it on the call side or something with that unbalanced fly again. Something like this, but we need to move it up a little bit more. Stocks at 315. I went with 310. I don't like it. Bump it again. Oh, because we don't have a 315. Well, that explains it. I think 320 is probably too far away, but whatever. Let's do it anyways. Oh yeah, that gave us more room. We got upside here into 325. That was the spot that I had named to begin with. Let's set that to break even and then put it on the chart so we can all see where break even is. Right there. I like that. Stock's got to stay below that level or we start to lose. The combined risk in this trade's a little heavy because it's $10 wide spreads. We can't make it any smaller. You know what I mean? Like that's just it's $10 spreads. And the way that you're supposed to do this in if we weren't on paper is you would have a set of rules about trading stocks that have wide strikes. In in my own trade rules, I don't like to trade stocks that have $10 wide strikes, especially when those stocks aren't even $1,000 stocks. If this was the SPX, for an example, I would be more willing to compromise on a $10 wide strike. But it's not even a $500 stock and they've got $10 wide strikes. That's not good, right? But it's paper. We're just throwing trades on. If we went to the upside above this break even point of 326, we'd start to get into loss. Max loss is $700. Minimum profit is $300. And it's got the sweet spot here of $1,200. So if we just fall and fall and fall, bare minimum, we make $300. I think we bounce. And then if it stays weak, then we fall. So if we catch the bounce, we can get it up here. But this is not a time trade, right? This one will this one needs time. You can't just have price go to 320 and then collect $1,200. It's got to be in that neighborhood closer to expiration. With all of those charts on or those trades on, let's see where we're at in the beta weight. We're still running at a -3. So we've kept it pretty good, right? We didn't get overbalanced too heavy to the upside or the downside. Fill my trade already. There we go. So if we look at the analyze tab, make sure you set that back to S&P, right? Because it'll change up there if you don't. And then you'll be wondering why the beta weight looks so weird. Yeah, we got some curve in that thing now. We still have to fix this shallow area, but we didn't start from scratch. We're having to fix a portfolio that was already bent heavy to the upside. And we don't really have a lot of neutral trades on, like iron condors and stuff, or anything sitting where we are right now, which would help with this central area. You can always find a trade. Bump this out a little bit more. That's a good support level. Breaking that offers more to the downside, but we've already went to the downside pretty heavy. In the near term, I would expect a bounce. And even if we break that first, I would still expect a bounce. So I'm thinking iron condor here or another one of those broken wing butterflies. The iron, because if you think about the bounce, you got the high, lower high, lower high. This thing is headed to the downside. And if we get a bounce and then it falls back down, we are right back where we started, right? So we fell hard, maybe we bounce. and then we come right back down and possibly go lower. If we don't bounce, then we fall all the way through and then we bounce and we're right back where we started again, anyways, right? So I'd say an iron condor trade or even a butterfly right here in the middle would probably be better than trying to buy a call or buy a put at this point. So let's see if we can put something together. Let's try 20, 30, and 05, 95. It's a $10 wide spread, 642 in credit, which means we're running it a little tight. And we need to turn off the beta weight. There we go. That's a pretty tight iron condor, all things considered. Probably want to widen it out a little bit, but let's look at the strikes. That was the wrong one. Now, this is what we used to do, but it was on a live account, right? Not this paper stuff. Paper's okay, but you know what I mean? Like, making money's better. So that's not too bad. I know it feels a little narrow, but we've got a $15, that's $30 wide. The expected move is $25 wide. We're good. That's paying us really well. So what's the risk? We are risking 400 for a chance to make 650. All right, we're risking 350 for a chance to make 450, 650. Da, 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 da. Dang it. One more time. We're risking 350 for a chance to make 650, right? I like that. Let's unlock it. Yeah, we're good. If we was going to work the order, which we haven't been working the order because it's paper, what's the point? We would want to get more credit, right? So you'd try to bump that up to like 645, maybe even 650. And then, when it doesn't fill and you've waited 10 minutes or so, lower it down a little bit and then try it again until you eventually fill. But on paper, it is whatever, it doesn't matter. Now, of course, you can add things like what's the volatility. That way, if you are going with out of the money options, you're not buying it when volatility is really high, or paying better attention to where the earnings are at, dividend, if there is any news. Have they made any announcements about diluting the shares or any merger talks, anything like that? Right? You can add so much more than what we're doing, but even with none of that, you can take 6-week trades all day long by doing just what we're doing right here. Because at the worst comes to worst, you get a significant market downturn that just drops the whole marketplace. Well, we've got some shorts on, right? So we're not going to lose on all the trades. Or we get some big, wild, crazy news and everything rips to the upside. Well, we've got some longs on, right? We're not going to lose in all of our trades. And that's the whole idea. It doesn't matter which side we goes, we're going to get something. So Caterpillar is still in trend, higher highs, higher lows. We're still in the middle of the week. We got some problem with what is that? 505. Yeah, we can't really seem to stay above 505 at the moment, but we're still setting those higher highs and higher lows. And Caterpillar is directly connected to data centers at this point. All those SMRs and OKLOs and all those guys, that's why Caterpillar's doing good and John Deere's not. So I don't necessarily want to short this thing. but we obviously have a problem with that 505 area. This is a little tricky one, and it's wide. $10 wide, a dollar 20 in a bid ask spread. Oh yeah, this is a really good example of what bad looks like. It's bad. Let's try something cheap. What was that strike? The 50% level is 485. We don't have an 85, but we got an 80. Just buy a butterfly, 68 cents. It's a bit much, but I mean, it's $10 wide. You're not going to get it any better than that. And inside of this, we have a put vertical long and a put vertical short. So once we get it on, we got 42 days. If we need to, we just start rolling one of those verticals higher or lower, right? That's how we would manage this so that this $65 can be managed. There's a little trick that you can do with Thinkorswim too. I don't know about all brokers, but I know you can do it with Thinkorswim. You could put a butterfly on each side, and then if the market stays sideways in between the two butterflies, you can close part of each butterfly and build yourself an iron condor from the scraps. I've done it on Thinkorswim. I've never been able to do it on another broker. Yeah, we do. A lot of times we do, right? Kind of like the tweezers that I pointed out in the market the other day when I was doing the live stream. So before today's dump, we had a big move up on Wednesday. And I said, it doesn't look like a big move now, but we had that big up day on Wednesday. So Thursday morning in the briefing, I pointed out, look, we could get the reversal of this in a single day. And the example that I used was this day right there, where we had a really big up day and then we just unwound it the next day. But you can get a big move down and then unwind it the very next day. And it happens a lot more than you would think. The problem is of how far does it go, right? So like back here, that was a really big down day, really big down day. And when we take that in relation to these other candles around it to try to, like, well, how big is big? This one day was almost a 4% day, and the average was less than 3/4%. So that's a 4x move compared to its cousins. It might take a little time to do that because it's hard to imagine you're going to get a 4x reversal or a 5x or a 3x um, the very next day. It can happen if you're in a high volatility environment like we were back in April, but that was multiple big days down and then one big day back up. So at the moment, we've only got one big day down, and we did not bounce as quickly like we did here or even here and here. Those were pretty good sized moves to the downside. We bounced and ran back up by the end of the day. We're not seeing that bounce. Instead, it's more like a Marbozu bar, right? It's not a Marbozu because we got wick up here, but we're we're not even like at the mid. So it's hard to imagine that we get a 3% move back up. Well, we can go sideways on Monday, right? Just because we don't bounce back up doesn't mean we got to go lower, but we can definitely go lower. Yes. So um, we can go lower, but it's more likely that we go sideways Monday. That's more likely. What I would want to see Monday is that we open and we try to come back towards this midpoint, this half, or a gap and go. Let's see if we can find one of those. Of course, I'm looking for it. We're not going to find it. I might have to go to the SPX. This is a really good signal at the lows. Let me find. There's one. Well, that's not a good one. We might come back to it. If that's the best we can find, then I'll use that. But let's keep looking. I know we've got a better one. I've used it. Okay, this will work. So right here, this is the best sort of Monday open that I love to find. Multiple days in the row that you're closing at the lows, you're closing negative, and it's just red, 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 red. And then on that Monday, well, that's not even a Monday play, but it'd be better if it was. On the next day, in the overnight, the S&P is falling, the Nasdaq is falling, everybody's screaming. You get the 9:30 open, and it gets just a little more negative into the 10 a.m., and then it flips and rips. I love those. That's a fantastic play. And you can find the red version too, where we open and we fall, 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 and then we run back up and we close lower than where we opened, but we still close way up off of the lows. That's another really good reversal day. Kind of like one of those right there. Kind of like that, but more being the last bar in a run, not having a fall and then bouncing and then having a fall and having that day. You want it to be the day, like this one. Red day, big bar, and then reversal. That's a good one. Red day, big bar, reversal. So you can get them. And I've called a couple, which is always really nice when I can look back the next day and be like, I called that live in the morning briefing. One of those mornings where, we're really crazy red and it's nasty. And I go out to the daily and I'm like, okay, guys, watch out because it could do one of these. And I describe it and I find it and I draw it and then we get it. I love it when that happens. One, we get to trade it and make money, and two, I get to look back later and say, I called that in the pre-market before it even happened. The great thing is my morning briefings go back for years. So if you find one on the S&P, look at the date that it happened, and then go back to the morning briefing and watch it and see if I called that reversal. I know it seems like a lot of work for nothing, but the point is you can spot them in the pre-market before they happen. Not always, but if the signals are there, then yeah, there's one of those flips. Um, it's not as good as what I would like for the example, but it'll do. 3 red days in a row, and then on the rally back day, it closes higher than the mid, and the next day, nice follow through, and it was just a run and a gun. But that's a TRB kind of. It didn't have the big explosive single day push. Wish I could find those examples. I know I've got some in the notebook somewhere. This day is the one that I keep coming back to. I'm pretty sure I called that one too. October 13th, my wife's birthday, 2022. Yeah, today's the first real red candle coming back to, well, I mean, yesterday really was the start of it. Today they just tried to close that gap. Not even tried. They did. They closed this. It wasn't even a gap. It's a liquidity gap, not a real gap. They closed that and then down we went. See, look at what we did in price today. All we did is ran up and tagged the previous day's open and then down we went. And we got implied vol that actually stuck around. Because look at yesterday when we were selling all day yesterday, volatility was not really doing anything. I don't disagree with you. I think that Monday can be another red day. It can. Absolutely, it can. Just don't think that it has to be another red day. That's my main takeaway is that it doesn't owe us another red day, but it could give us another red day. Especially with so much uncertainty and the government shut down and we're not getting data and we've got potential for the ceasefire to not work out, more issues potentially with China and the tariffs and the rare earths, issues with the whole Russia Ukraine situation. That's three different global incidents. Then there's Japan with their new prime minister. There's France with their new prime minister. Venezuela. That's what do we have to? Six global national events. That's a lot of risk. On that bounce Monday, look to see if we get above that 786. If we do, we can go to the half. I forgot to close a trade. As long as the entire thing is in the money, and I'm pretty sure the entire thing is going to be in the money, then it's not going to be an issue. But I'd rather get it closed in the 30 seconds that I've got left. Come on. Yeah, it closed. No, it did not close. But the entire thing is in the money. So it will close safely. I just don't like it. All right. Well, that was SPY. The SPX, as soon as the bell rang, they said, nope, you can't mess with it because it's cash secured, blah, blah, blah. But I got the SPY one closed, and that's all that counts. All right. Whew, that was close. Not that it would have mattered. They were all in the money, but it's the principle of the issue. I had some butterflies on because I thought this would be a normal fall, not a 4% fall. It's not four. It just felt like four. What is this fall? Three and a half, three and a quarter. Yeah, that's more than what I thought. I thought two. Remember in the morning briefing, I said 2%, not three and a quarter. That was a bit more than I was looking for. All right, so um, I'd say that we wrap it up. And we come back into it next week. This this approach that we were doing here, just putting on trades, some of them can get a little tricky, like Boeing was, or maybe that Amazon one or something. But for the most part, it's all about just keeping perspective on what your risk is and what's your plan to deal with that risk if it comes along. Where I see people really making mistakes is that they'll take extremes. They'll go way out of the money, or they'll just go straight long in a call or straight long in a put. And that makes it a lot harder to offset that risk if risk comes at you, right? So then you're net long in like every trade you're holding, or you're net short in everything you're holding. And then the market goes against you and you don't have anything going the other way and you get hurt really bad. If you do it the way I was showing, where you've got a mitigation of risk, you're doing them in spreads, you got a plan on how to deal with it, you'd be surprised at how much you can carry and not have big losses coming at you from either side. When you get to that point in your trading, you won't be sitting there every day going, "Gosh, I wish I could just find a trade," because everything is tradable always. And you'll just have so many of them, you get to be picky about it, right? Because that's what's cool when you start getting picky and you're like, no, that's not good enough. I don't like it. You got to do better than that for me, or I ain't taking it. And that you've always got to trade. Yep, everybody. I hope you have a good weekend. I'm gonna try to get the bike out. Uh, it looks nice as long as it ain't too windy. And there's talking about it's gonna be cold next week, so I want to get the wind in my hair before it gets nasty. Have a good weekend. I'll see you all on Monday.